We are very, very, very appreciative of the great panel who have been able to make the time here. And let me first introduce the main speaker today is Professor Léonce Ndikumana from the University of Massachusetts at Amherst. And he has a very interesting title, Distinguished Professor of Economics and Director of the African Development Policy Program. Indeed, he's distinguished in many ways. I've had the pleasure to know Léonce for decades and work with him on so many projects. And I always value his distinguished nature. I think one other title you had before was Professor Extraordinaire, which is an honor kind of professor. But Léonce has really made a great contribution to our understanding of especially African economies, but globally in the field of economics and finance. And I can recount on many occasions when his contribution has been highly valued. And our paths keep on crossing at various dimensions. For example, we are both chairs in the African Economic Research Consortium. He chairs Group B, macroeconomics. I chair Group C, finance. So we can't avoid getting together twice a year in this contributing knowledge. But also, Léonce was, director of research and later director of policy at the African Development Bank when I was also director of the African Development Institute. I could go on forever, citing some of the cases. But his fundamental contribution, especially in the measurement of capital flight, an area where I have also worked on, have completely changed the way we look at African economies and global finance. In particular, I remember the revolving door syndrome. But in this seminar today, Léonce is going to look at national development banks. Is there a case for national development banks in Africa? I published a book on development banking and finance way back when I was young in 1996. But by that time, national development banks were not getting very good reception in terms of academic discourse, as well as in policy. But the pendulum has swung on from there. And what Léonce is doing is looking basically critically at these national development banks and trying to push the agenda forward and trying to, point out, issues we should deal with and taking both theoretical, empirical, and other important observations, having been a development banker himself, as I mentioned, some time back. But today we made it extra special by saying we need to listen to Léonce, but also we need to listen to practitioners who are actually leading, managing national development banks on the continent. And that's why we are very delighted here to welcome important leading CEOs on the African continent who have been kind enough to join us. And for very briefly, 5-10 minutes, highlight some of the challenges they face on an everyday basis, okay, so that it can inform us in terms of guiding, what we research. And this include Madame Kampeta Pitchette Sayinzoga, who is the CEO of Rwanda Development Bank. And can I ask Kampeta to wave up your hand so that I can see you? Thank you very much for joining us. And again, I remember when I was at the African Development Bank, Kampeta was then the leading official in the Ministry of Finance of Rwanda. And we had the occasion to arrange the annual general meeting. Since then, I remember that very exciting general meeting we had. Thank you very much. And we shall later on invite you to take about 5-10 minutes about the Rwanda Development Bank. But we're also pleased to have Madame Patricia Ojangole. Patricia, I'd like to wave your hand there. So, yeah, so who is the CEO of Uganda Development Bank? Patricia has been very active, not only being as a CEO, as a practitioner, but also in contributing to academic discourse. I very well remember the conference where you, contributed enormously at the University of Groningen in the Netherlands a couple of years ago. And also we have with us Madame Lucy Chege. Lucy, what is Lucy? Yeah, Lucy Chege, who is the head of Energy, Environment, and ICT at the Development Bank of South Africa. Thank you, Lucy, for being able to join us. But we have invited another commentator who has been looking at national development banks, but from the perspective of Latin America. So we'll bring in a Latin America angle, Professor Stephany Griffith-Jones, who is very well known to many people here, but recently published a leading book with the Jose Antonio Ocampo. The book is published by Oxford University Press, and Stefan and I were very, very excited to come and launch it to the policymakers in Brussels at the EU meetings. And we look forward to listening your contribution in terms of weighing in from the Latin American angle. Okay, so thank you all. Without any more words, let me call upon Léonce to start his presentation.
Okay, thank you, Victor, for the kind introductions. I didn't know I had so many titles. Some of them I remember, others I don't. But also I want to first thank all the colleagues who have taken time to come and listen to us and talk to us about the various experiences, especially the busy CEOs who from the same institutions we're trying to study, who I know have a very busy agenda. So we hope that you'll find this time well used in terms of the discussion we'll have here. So I will share hopefully the technology will help us do that.
Brilliant, it's worked.
So do you see it?
Yes, we do.
Except I don't see it. Okay, let's see. Okay, what do you see now?
Okay, now it's a full.
Okay.
Yeah, the full.
Excellent.
Yeah.
So the title I chose to use is there a case for national development banks in Africa? As Victor was saying, this is a topic that has been in discussion for a while. There was a time where it was almost taboo to talk about national development banks because they had not performed very well, especially during the 80s and 90s, and were a strong push for privatizing them, dismantling them. But then I think the pendulum has swung in the right direction, and now there is a more interest in national development banks. But still, there is a lot of skepticism. I remember when I presented at the initial meeting of the project, at least the meeting I attended where I presented my idea. We had some very interesting discussions with my colleagues, especially people in theory, who said, what's the theory behind a national development bank? Why do you need a national development bank that cannot be done by other people at the banks? So I'll go through some of the arguments as we go before I dive into the meat of the paper. But I want to again appreciate the opportunity given to me by Victor to join this unique project. I think it's a project that has a lot of potential, especially from a development policy perspective. Africa needs finance, but Africa needs good finance. So it's important that we see how to establish functioning, efficient financial systems, efficient financial institutions. I also appreciate Victor's help in connecting me with development banks, especially the Uganda Development Bank. I'm very happy to see Patricia here. We have interacted on electronically. I'm glad to see her now live. I can pretend it's face-to-face. But also Victor has really helped me with access to BankFocus with his colleague Atina. I didn't see her on the list. Maybe she was very helpful. And in anticipation, I want to thank Stephany for. I'm sure she'll have some useful insights. Every time I talk to Stephany, after I speak to Stephany, I feel more intelligent about finance because she's just a wealth of experience on international finance. And I want to thank everybody, all protocols observed. So quickly, I'll talk about some of the theoretical perspectives about why we need development banks, because I think this is an important point to be made over and over again, because there are still people who have lots of doubts about why do you need governments to intervene in the financial system. And then I'll briefly review the existing global empirical evidence, because this is really important. Even though I'm interested in national development banks in Africa, it's important to learn about what exists in other countries, what has worked and what has not worked. And one of the advantages of doing that is to help us make the case for why national development banks should be taken seriously. Then I'll talk about my research questions, the research design, and then I'll share some standardized facts from data from national development banks in Africa, the ones we have already been able to collect remotely, and some by physical visit to the banks. And then I'll talk about the econometric analysis that we are involved in, and I'll give you some preliminary. I could still call them preliminary until they are published. They are always preliminary. And then I'll talk about the way forward. So. Why national development banks? National development banks, whether anybody like it or not, they remain an important part of modern financial systems, both in developed and developing countries. Some of the biggest banks are development banks. If you go to Brazil, the biggest is the National Development Bank. If you go to Germany, the German Development Bank is quite big, and their relevance has even actually been reinvigorated after the aftermath of the 2008 global financial crisis, because this crisis put into question the notion that free market-based financial systems are efficient, and they are all we need to move to mobilize resources and allocate them effectively. We know now that left on their own, financial systems can be a source of great instability, and in especially that if they are left alone, there will be sectors and individuals and businesses which will be left behind. So that's why the discussion about National Development Bank is very much welcome. And in fact, you see that in many countries, in some countries, there are even new banks that are being created. In Nigeria, there's one that's not five years old. And I wouldn't be surprised if tomorrow there's another bank that's created in somewhere in the world. Simply said, national development banks are generally seen as institutions which are fully owned or partially owned by governments. But the key point is that they are given an explicit legal mandate to reach social development goals in a region, in a sector, or in a segment of the market. We can even take a simpler one with a definition which says that development banks are government-sponsored financial institutions concerned primarily with the provision of long-term capital. And the key here is long-term finance, because the concern is that private banks, commercial banks, tend to be risk averse, and they shy away from engaging in long-term capital, which evidently is indispensable for industrialization. Now, if you listen to talk about development in Africa now, it's all about economic transformation and industrialization. That will not happen if you don't have long-term capital, or patient capital, as we call it. But why do we need a national development bank? In economics, there is this view that free market-oriented financial systems are supposed to operate efficiently in mobilizing and allocating resources. That we all teach. Victor, I'm sure in your finance 101, you tell students how free market systems allocate the finance to the best users. But unfortunately, it's not always the case that left alone, financial system will allocate resources effectively to meet the needs of society. So that's why from a theoretical perspective, it's fair to ask, why do we need development banks, and specifically, why do we need banks to governments to intervene in the financial system? Why would government know better than the market to gauge who needs investment and who is going to use it more efficiently? So I think we can't just dismiss it. We should address this first on and provide evidence to justify why national development banks are a value addition to the financial system. In terms of theories of national development banking, they basically draw from the issue of financial market failures, which arise from asymmetric information moral hazard, missing insufficient collateral, high transactions cost, and term mismatch between the funds needed for long-term investment and the funds available in the market. And those failures arise from both the supply side and the demand side. And the main consequence of market failures, for our perspective, is the shortage of long-term finance. If you talk to policymakers in Africa, the main concern, the thing that keep them awake up all night, is how to finance long-term investment. Risk aversion basically results in under-provision of long-term capital, but also there is a risk that commercial banks will under-invest in knowledge generation. Knowledge is very important in terms of being able to evaluate investment opportunities, being able to monitor, but that knowledge needs to be developed, and it's costly. If you leave it to the free market, there may be little of it being created. All this means that the case for national development banks then is even easier for developing countries, African countries in particular, where markets are imperfect, information is inadequate and is asymmetric, but also these are countries that need the most long-term finance to get the private sector going, infrastructure going, and so on. So from a macro perspective, the case for national development bank arises from the inherent pro-cyclical nature of financial markets. If you see, the financial markets are the source of instability, but they also tend to overreact to negative shocks. So they are very, very pro-cyclical. So if you look at the literature on development financing, there are four views or four arguments for the role of national development banks. The first one is a development view, and this is probably the oldest, where it was argued that you need specialized institutions that are able to provide the type of patient long-term capital to fuel economic transformation from way back at the 40s and 60s. Then there is a social view, which basically drives from the fact that investments may not have strong financial returns from a narrow perspective, but they may have huge positive externalities, in which case somebody needs to pay to cover the cost that is going to be involved in financing those activities, and the free market may not be willing to do that. So you need specialized institutions to provide that kind of finance. The macro view has to do with the fact, again, that finance tends to be pro-cyclical. So you need institutions which are going to be counter-cyclical and lending during bad time, where the private sector needs it the most, and national development banks which are well equipped are likely to provide that service. There is also what is referred to as the life cycle hypothesis, which basically says that national development banks emerge in countries with some solid institutions, but incomplete, inefficient financial markets. So they fill a void, and they grow alongside industrialization and the development of the financial markets. And they are assumed to wither and die as the countries fully developed. But when we look at the evidence, that cycle is never complete, in the sense that we do see, in fact, that a strong role of national development banks at the beginning and during the process of financial development, but the efficient one, the competent one, remain active even in fully developed financial systems. So it's a different way of looking at the life cycle. It doesn't end. It seems to be only becoming better and better. Now, in terms of empirical evidence from a global perspective, we see very strong historical accounts of the role of National Development Bank in promoting industrialization, promoting economic transformation. As I said, there is this new book by Stephany and Ocampo, which has very interesting case studies. And what we see even also from the World Bank surveys of national development banks is that we see that there are varieties and heterogeneity of experiences, which is a good thing because it offers opportunities for learning from successes and maybe also failures to avoid the same mistakes. But in addition to the historical evidence, what's interesting in the field is that there is a growing body of very good, rigorous empirical evidence on lending behavior of national development banks and their impact at the firm level, at the sector level, and also at the countrywide level. And so this evidence is very helpful in helping us to test the theories of national development banks that I reviewed. The book by Stephany and Ocampo have some really, really nice case studies using data from banks on firms and sectors, but also at the country level. And that from this literature, what we find is that national development banks tend to increase lending during downturns, while commercial banks are reducing lending. So, for example, for the 2012 World Bank Global Survey, which covered 61 countries, they find that lending by development banks increased by 36% during the 2008 recession, compared to only 10% for commercial banks. And in the most recent survey, they found that 50% of the development banks increased their lending above national average. And interestingly enough, 70% of those that increased lending were in developing countries. So there is some good things happening. There are some good things happening in developing countries. At the micro and sectoral level, that's when people use sector level data and firm level. There are two camps, as I call them. There are the naysayers, who I call the negative camp, who argue that the state-owned banks, generally, not just national development banks, is a bad thing because they are associated with overall worse macroeconomic performance, reducing growth and financial development. And a famous study by Laporta, Lopez de Silanes, and Schleifer argued strongly that national banks are a bad idea, that it's an inefficient allocation of resources. However, that study has been really challenged from a technical perspective, based both on the sample. Their sample include a large number of socialist countries which have only public banks, so there is no benchmark for comparison, but also endogeneity that was not controlled for in the analysis. And when these problems are addressed, it appears that their results no longer hold. So the evidence that we see that's more rigorous tends to show that government banks exhibit higher loan growth. An example is by Bray and Shaklarek, which is in the book by Stephany and Ocampo, who find that national development banks and private banks increased lending growth rates in crisis by 3 times and 2.5 times respectively, relative to normal times. In contrast, commercial banks reduced their lending. Other studies also find that national development banks are associated with lending by national development banks is associated with increased output, increased employment, and new business formation. So the notion that they use resources efficiently is not supported by the evidence. And also, very importantly, especially for theorists, national development banks do not allocate funds to failing institutions. They actually lend to both weak firms, but also strong firms. And the most important part of this finding is that after the lending by national development banks, firms become even more productive. Okay, so the lending by development banks is efficiency enhancing. But this literature, when you comb through it, there is one glaring void, which is empirical evidence on Africa. Most of the great studies are on Latin America, Asia, and developed countries, but Africa has not seen as much activity in terms of research. There are some historical accounts, but what we hope to do is to be able to document with good empirical evidence the role of national development banks in Africa, using case studies, using also cross-country analysis. So that's where our research agenda fits, to expand the analysis on the role of development banks in African countries. So I have what I call broad research questions, which are going to keep me until my I don't know when. So the first one is to keep hammering on the issue of the motivation for national development banks, because there are many agnostics, and we need to find a way to convince them with good evidence. And then specifically, I want to look at whether national development banks play the expected complementary role to commercial banks. Commercial banks are still going to be the backbone of financial systems in Africa, but we want to see how national development banks can complement the role of commercial banks, especially by providing long-term capital and more risk-tolerant lending. And one of the things I hope to be able to accomplish by talking to National Development Bank management, combing through their records, is to look at the institutional macroeconomic regulatory conditions that enable the efficient development of national development banks in Africa. But that's something that, again, is going to take time. What we hope to do is to generate more interest with other people, so that a pool of researchers could be involved in this analysis. I wish, for example, ARC could take this on and launch a number of researchers doing case studies, and to see whether we can also learn from experiences in other countries. But specifically, I'm going to look at a number of questions, and I'm going to share some of the results with you. The first one is whether development banks lend more than national development commercial banks, given bank characteristics. For example, for the same size, for the same amount of resources, do they tend to exert themselves into in lending more than commercial banks? Is bank performance related to the bank characteristics? Do national banks perform better or worse than commercial banks for comparable conditions? And then, do they manage resources effectively? Are they more profitable? Do they manage well their loans in terms of loan recovery? So in terms of research design, in terms of my broad research agenda, it will involve country case studies, which will involve a lot of field work, but also, and then so the second part will be econometric analysis along the lines of existing studies that I referred to, which were on Latin America. But today I'm going to talk about the second part, while also giving you a flavor of what could be coming out of the case. Because my view is that the first part is actually richer in terms of informing policy when you can actually document particular outcomes for a particular bank, and then see what other banks can learn from there. So stylized facts from what we have been able to gather from the literature and evidence from specific banks. Again, financial development banks have been part of the financial system in Africa for a long time. In the 60s, after independence, they were a big tool of state-led development. But then 80s and 90s, trouble with the structural adjustment, liberalization. So the arguments were made that they're a bad idea, that governments should privatize them or just dismantle them. However, now we see that the landscape is much better. You have a much more positive vibe. So it's an opportunity time to learn about what is the role of financial development banks. So thematically, when I look at what we have been able to gather from the data from banks, in terms of the mission of national development banks, if you look at the literature on each bank, it's very, very clear. They are seen as an instrument of national development, and most of the time they are given a particular focus. For example, industry, manufacturing, and so on. I'll give you an example, and that's reflected in the allocation of lending. I'll give you an example on IDC. But also, the development banks are seen as an instrument for achieving equity and inclusion. So it's not just about efficient markets, and that's why you see IDC, for example, playing a role in the Black Economic Empowerment Program, but also providing tailored finance to SMEs. The other issue is whether national development banks are helping in alleviating market imperfections through long-term lending. When we look at the data on specific banks, the picture is mixed. In some banks, you do see that there is really a focus on long-term lending. In others, it's not clear. Their numbers don't seem different from commercial banks. I'll give you an example. How about pro-cyclical lending? Yes. Again, from bank-specific data, there is evidence that national development banks step up to the plate and provide lending during bad times. Here is an example of IDC, which rolled out $6 billion during the crisis to support distressed sectors and firms. Do they allocate resources effectively? Here, when we look at the share of loans of national development bank within the country, they tend to exceed the share of assets, in the sense that national development banks actually punch above their weight in terms of lending, which is quite good. Do they crowd out private commercial banks? There is no evidence that development banks crowd out national commercial banks. I'll give you an example using just interest rates. So they don't undercharge relative to commercial banks. Are they more efficient in utilizing resources in terms of loan recovery? Here, the answer is mixed, in the sense that it's actually quite common that non-performing loans are higher for national development banks. Are they profitable? Not so sure. An interesting finding from my analysis of the data is that the loans from national development banks have high social value added. An example is the Uganda development banks, where their lending to agriculture creates a substantial amount of jobs compared to lending to manufacturing, for example. So there's a case for targeting lending. So there is a lot to be learned from the data from national development banks. They're doing a great job. I think they need to be commended for that. I'm going to skip this because I have talked about it, and so I can go to the econometric analysis. I'm going to be using BankFocus data, which I obtained with the help of Victor, which covers 52 countries. But of course, data in the regressions is going to be low, depending on the availability of data on each variables. The sample includes 49 development banks and 86 public banks. These are national development banks, but also bank owned by the government. When you look at the data, you tend to see that national development banks, yes, they tend to be, their lending tend to be tilted to medium and long-term compared to, say, commercial banks, which is what we want to see. National development banks, again, exhibit higher non-performing loans compared to commercial banks. In fact, in some countries, they tend to lend more than commercial banks on the right. So they're quite active. So in terms of empirical analysis, I'm going to be asking specific questions. The first question I ask is, do national banks lend more than commercial banks? And then specifically, do they provide more long-term lending than other institutions? And this, I'm going to use a very simple model, which basically look at lending, both total lending, but also medium term and long term, and look at how this is influenced by the type of banks. So the first term is about characteristics of the banks. The second term includes country characteristics, but also the nature of the bank. The DI is a dummy for banks, for the type of bank, one for national development banks, and also do the alternative runs for public banks. So here's the result in terms of total lending. The question was, do national development bank lend more than their counterparts, which are private? I don't show you the results for the other variables. Let's focus on just the nature of the bank, national development bank. The first row says, if you are a national development bank, are you lending more? I start with a very simple model, a baseline model that includes just the characteristics of the bank, core control variables, which are the size of the bank, the government effectiveness, growth, and a dummy for and growth. But then I add financial development, dummy for financial development, and I interact the two. When I bring in the degree of financial development and interact with the type of the bank, I do see that national development banks do lend more than their comparators. That result also holds when I include the structure of the economy, which is controlled by the endowment in oil and natural resources. But when I control for all the characteristics of the banks and all the conditions in the country, I no longer see that national development banks lend more than other banks. Of course, we have more lending in financially developed countries. The results are the same when I use national development public banks as opposed to alternative to national development banks. So generally, we don't see that the national development banks, given the characteristics, given the capacity, lend more than public banks. The story is more interesting when you look at the term structure of the loans. And remember, the mission of the National Development Bank is to lend long. So we look at the share of medium and long term in total loans, and we see that there is some evidence that national development banks tend to offer more long-term lending than their comparators, and that tends to be reinforced if they are in a developed country. But the result no longer holds if we put all the controls. So which means that there must be some cross-country heterogeneity in this result. But interestingly enough, consistently, when you use public banks, they lend more than their comparators, even when you include all the controls. So that's a very interesting result. The second question I look at is whether National Development Bank manage their resources efficiently. And here I use non-performing loans. And the same equation as before, except that I used the term structure of the loans, short term, medium term, and long term. what I find is that systematically national development banks have more non-performing loans that compared to their comparators. Interestingly enough, the regression analysis finds that high lending does not correlate with non-performing loans. So banks should not be discouraged from lending. They're doing a good job. It's actually negatively related to non-performing loans. Similar result for public banks, but for public banks, in fact, we find that when we have a model that controls for all of the characteristics of the banks and the conditions, public banks have less non-performing loans than their comparators. So they are more efficient. And again, we still also find that lending is not correlated, is negatively correlated with non-performing loans. How about performance? Here we use the returns to equity, returns to asset. I'm going to show you the result with the returns to asset. On its own, being a national development bank does not enhance profitability, but being a national development bank in a financially developed country, financial system is correlated with higher returns. That's interesting. I think it would be interesting to discuss why that is happening. But also you find that, of course, total lending is positively correlated with returns, but also the short-term lending is negatively correlated with returns. So you wonder, why do banks insist on lending short when in fact the short-term loans are bad for profitability? Same thing when you use public banks. So this is quite interesting. We need to know what are the development banks benefiting by being in a financially developed system that allows them to be profitable. So to summarize, we find that development banks remain a major part of the financial system. They are a tool for national development. In terms of econometric analysis, we find no robust evidence that public banks lend more, but there is some evidence that they lend more on the medium term and long term, which is very, very encouraging. They do have more non-performing loans, which is not surprising because they are supposed to be tolerating more risk. And national development banks are relatively more profitable in countries with financially developed system, probably benefiting from superior technology and know-how, and then dynamic in a more dynamic private system. Next, I'll be refining these empirical results, but my more exciting undertaking will be to look at institutional and governance dimensions. And that's where I hope to be able to, when COVID is over, cruise the continent, talk to CEOs of national development banks, and look at what is your government model that allow you to be successful, and what is it that makes it what is it in the country or your host country that makes a national development successful. That will allow us to answer the question about efficiency, profitability, both from a cross-country perspective, but also from a cross-institution perspective within the country. I know I was long. I'm sorry. Thank you very much for listening.
Thank you very much, indeed, Léonce. You've smashed it very well. Your presentation was very clear and very fundamental. You looked at the issues in an historical context. You invoked the relevant theories and reviewed, and then specified a plausible, very beautiful and plausible model. And this model was not assassinated by agri-facts. No, combined with data, you were able to generate some very interesting findings. And most importantly, you were able also to look into the future in terms how we should go, what issues we should look into, especially at the individual or country-specific level, looking at individual banks. Excellent presentation. Thanks very much. Okay, so now it's my great pleasure to call upon the discussants to ask each to say something for about 5, but not more than 10 minutes. So I'll go in this order. I will first call upon Madame Kampeta, and then Madame Ojangole, and then Madame Chege, and then Professor Stephany Griffith-Jones. So, Madame Kampeta.
Thank you very much. Thank you.
Muraho.
Thank you very much, Professor Léonce. It was a very interesting presentation. I was following attentively. Maybe I'll try to bring the view of the practitioners, which, by the way, do not differ from the presentation made by Professor Léonce. Let me start with maybe where he ended, which is Rwanda is one of the countries where the development bank is actually regulated by the central bank. So I'm very curious to see in your next round of investigation, what's the difference between banks that are regulated and those that are not regulated, and see the outcome of that. But we're one of those that are regulated. I think, Victor, you've asked me to look at some of the challenges that we're facing as development bank. Let me list 4 challenges and I'll be very quick. The first one is one of the objectives, as one of the mandates that we've been given as a development bank by our shareholder, the Ministry of Finance, is to make sure that for every dollar of capital that we're given as BRD, we're able to leverage that capital to actually bring in additional financing for the private sector. And that means that every dollar that they give us, they expect us to be able to leverage, 2, 3, 4 additional dollars from the financial world out there. That's key because, of course, Rwanda is an economy that is that doesn't have the right kind of capital, or enough capital for the private sector based on our growth ambitions. But the challenge, of course, at the operational level is how do you manage pricing? How do you manage tenor? How do you manage FX risk? When a large source of your financing is actually from external borrowing, from DFIs, from fellow DFIs. So that's the first challenge that we meet, is volume versus terms. So of course, if you're not picky on your terms, you can get more money out there. But if you're picky because you want to keep track of your pricing to your final customer, your tenure, to make sure that we're able to provide long-term, as mentioned by Professor Léonce, if you want to make sure that you contain your cost by having your foreign exchange risk managed, then leveraging capital is, of course, a very challenging mandate. The second one is around product development. And I think one of the reasons why I like Professor Léonce's point around efficiency of capital, and if you're financed by a development bank, you tend to have better profitability for the business, is because we're able to have capital that is tailor-made to your business risk. One of the areas that is a constant challenge to us as a development bank, the second area is really product development, because lending for agriculture should be different for lending for livestock, which would be different from lending for manufacturing. And the commercial banks tend to have one size fits all when it comes to project finance, but development banks should not. So the second challenge that we face, and that we're constantly innovating or constantly reinventing ourselves, is around product development and making sure that these products are able to respond to the economic needs of the economic agents. Then the third one is our mandate to actually own land. So in Rwanda, BRD is also a provider of capital for commercial banks. So in sectors that are underserved, such as affordable housing mortgage, such as agriculture, such as renewable energy financing, what we do is that we get money on land from the Ministry of Finance, and then we ourselves on land it at much more concessional terms to the commercial banks. And the objective is to de-risk these activities for the commercial banks and make sure that if this is a World Bank project or an AFDB project, when the project ends, the commercial banks are not comfortable with the credit risk. So that means that at the same time, the commercial banks are our clients, sometimes a little bit of a competitor, but it's a challenge for us to make sure that the money that we receive, we're not only leveraging it to have external resources, but we're also using it to unlock some of the national liquidity that is available and incentivizing the commercial banks to go into underserved sectors that are key to our national development program. And then lastly, it's also positioning forward. So the Ministry of Finance sees us as a development bank, as the bank that helps them move from traditional sectors to more knowledge-based sectors, to more progressive sectors in terms of economic activity. So this rule of positioning forward is not always easy because, of course, creating new value chains is more risky than supporting existing value chains. And then it requires us to find new partners that have experience in these sectors. So the positioning forward is a new area, I would say, in this particular national strategy where BRD has a role to play. Right now, we are reinventing or re-engineering BRD to check whether we could be the leader institution in terms of green financing, whether we could be the leading institution in terms of blended finance, to be able to leverage once again, and especially in areas such as digital transformation, areas such as urbanization, which traditionally were not appropriately financed. So just to recap, I see 4 challenges: leveraging capital externally, product development for clients and at the micro level, leveraging the commercial institution to unlock the domestic liquidity, and then 4, positioning forward. I thank you. I hope I've stayed within your 10 minutes, Victor. Thank you.
Absolutely. Thank you very much, Kampeta. You smashed it, and very, very valuable contributions. Much appreciated. So let me have the pleasure to call upon Patricia next.
Okay. Thanks, Prof. Victor. Thanks, Léonce, for the presentation. I must say I'm very excited listening in and seeing that there is progress on literature in terms of the role that national development banks can play. And I'm saying this because I sat in a class where we studied global development finance and advanced theory and practice of development finance. And after those 2 course modules, I kept on wondering, where are national development banks? And, so that really is testimony around the fact that there is really lack of empirical evidence on the role of national development banks. And I think what the center is doing and what your study is doing is really great around that. Talking about the challenges of national development banks, I must say that these really vary. Each national development bank will have its own challenges based on a number of things. I've just listened to my colleague Kampeta and already seeing some of what may be her challenges may not be my challenges, etc. And also knowing what is really happening globally or actually on the continent around national development banks. If you asked me this question 3 years ago, I'll probably have a long list of totally different challenges than what I think are my challenges now. So it also really depends on where a national development bank is, across the life cycle. And I've tried to look at this, broadly because I engage with colleagues on the continent. As I have mentioned to you before, I sit on our Association of National DFIs on the continent, and we're always trying to engage members to see different things. But if you asked most of our colleagues today, they will probably tell you their issue is funding. They do not have adequate funding to carry on their mandates. Of course, there are various reasons why that would be the case. Some of them will tell you we do not have support from our government, and a number of them will tell you that, but probably that is different for me and for my colleague here today. Some of them will tell you there is a political interference. So again, that is probably different from the challenge that I would have today. And when I look at it from the association's view, for example, if you talk to our Secretary General and say, why your members, and it's true, not very many national development banks on the continent are really kind of progressing and executing their mandates well. And what probably will come from that level would be the issue of leadership. we don't have good leadership of these associations. And then they will also tell you there are issues around governance, okay, in terms of who do the shareholders appoint on the boards and who do they appoint, you know, to lead these institutions. So probably at global level, that's what the association would tell you. And now coming to UDB, I think a lot of these have been addressed. Like I mentioned to you 3 years ago, my challenges were different. I'll probably tell you issues around funding and some of these that I have mentioned. But as we speak now, in our case, funding actually is not a challenge. For some reason, the government has just decided they're going to put money and put money and put money, and they're really putting in money. Yeah, so that is what is happening around funding. And what I also realized is that with that, of course, comes a different challenge. The expectations around what is this supposed to do? And of course, in our economy, there are different expectations. And even as I think about challenges, I think about it and I'm like, okay, but this is how this is currently being addressed. So for example, one of the issues that, you know, I find myself dealing with on a daily now is everyone expects the bank to be doing what they want, yeah? So someone will tell you you're not supporting the micro segment, others telling you SMEs are missing out, what about this sector, what about so and so. So it is like you're expected to probably deal with everything, but there is just so much that can be done. That can be a challenge, but we're trying to deal with it in terms of, you know, mandate clarity. So you're able to explain and say, look, this is the mandate of the bank, or there is this other institution which is also owned by government that is supposed to be looking at this kind of segment. So I think if there is like not mandate clarity, that can really be a challenge. But where it comes from is probably lack of an appreciation by key stakeholders around why does this bank exist? What is it supposed to do? We have support, or the bank has support across all levels of stakeholders. We would have support from the executive, the president, we have support from parliament, we have support from our shareholder, the Ministry of Finance, but you realize that even across those key stakeholders, there is probably a division. Some will support or try to understand, some will not understand. So you may find like you're going this direction, that's taking you the other direction, but then at the end of the day, you have to revert to the constitutional, you know, documents that established and created the bank and said, this is the mandate, and of course, continuously trying to look into and working around those. So if there would be a way of really getting everyone, all stakeholders on the same page around this is the mandate, and this is how these institutions are supposed to be working. This is what they're supposed to be contributing on the economy. I think that would help. How we're trying to deal with it here is to have a kind of policy around national development banks. So we're working with the Ministry of Finance because we think when we put this together and kind of try to clarify, this position has to, first of all, be appreciated across the entire Ministry of Finance and probably up to cabinet all the way. And then that will really be like an anchor kind of guideline in terms of trying to keep the mandate and focus in terms of what the bank is exactly trying to achieve. Previously, like I mentioned, or even what we took over, there were issues around political interference. And I think when you engage most of the DFIs on this continent, this issue is probably going to keep coming up. But again, as I think this could be a problem, I think it is not a problem in our case because we have systems and structures that just would deal with this issue or problem. So actually, as we speak, it's not a problem where we are, but you'll still kind of get, you know, indications, or some people, like I've talked about, lack of understanding, appreciation that this is an autonomous institution. The fact that you are a public institution, I think there are inherent risks that come with it. So around still how people or stakeholders or the public expect that you should be kind of supporting, and they have their own understanding around what probably they think you should be doing. Now, of course, there's too much now, because you're a public institution. There's always too much politicizing by the public, by them stakeholders around everything that you are doing. So even though you whatever you're doing, they'll kind of try to politicize. So again, the way around is really kind of keep focused on this is what we have to do. We have results to account for. This is our basis, etc. And that has kind of that helps, but it really becomes quite too much. But I think just because you are a public institution, in case we are 100% owned by government, even if you have structures that establish the bank, as a company, as an autonomous institution, and that's how we run it, and that's the reason we've been able to register successes, some, stakeholders and the public will probably just not appreciate. They will think this is public funds, this is what it's supposed to be happening. But I need to say that this was actually not the case when this bank was small and it was underperforming just a few years ago. And but since the bank started really performing, growing, increasing, being more relevant, now we're seeing a lot of this. So I don't know what probably would explain that, but a few years ago, nobody cared, but probably because there was no funding in the bank, and like I've said, issues, the inherent risk of being a public institution. So probably that is where it is coming from. We did share some data with you, Prof. Léonce, at some point, but I must say that probably that was almost 2 to 3 years ago. And since then, the bank has actually significantly increased in terms of performance, in terms of size and capital and etc. And we'll be able to share the updated information if that can help. So maybe the other thing that I need to talk about, since we're now going to look into the institutional arrangements, and I know this is a key issue around most of our members, even ourselves still, even though the bank is a company, but like I mentioned, issues around the government ownership 100%, which is okay if the shareholders can get aligned in terms of this is what we want this institution to kind of deliver. And issues around governance, and I know this is a problem around most of our members, how their boards are appointed and then how the CE is appointed. In my case, for example, I think our memorandum and articles say the minister appoints the board members, and that has been the case. But now we are very careful. We know this bank has grown. We know we have lots of money to protect. So we need, for example, 3 new directors because the others are retiring. So we went to our minister with the board chairman, and we told the minister, these are the kind of people that we need on the board. We need professionals. We need these profiles of people. And was kind of shocked and surprised because it was like, but I'm the one supposed to appoint. We're like, yes, you will appoint, but this is the kind of profile. So instead of leaving it like, well, of course, now we know what we want for the bank and we have a good relationship with the minister, so we can go and discuss just about anything. It would be good if some of these are institutionalized such that even if my minister is not there or we are not there, my chairman is not there, whoever comes, find like an institutional framework that would really support, the bank to continue on a growth trajectory. Because then if that is not the case, you may find like today or tomorrow, when totally different group of, shareholders, board, management come in, and then the bank would easily revert. So actually what we are trying to do now is how do we institutionalize everything, where are the gaps, where have the gaps been lacking in our institutional document, just to strengthen issues around governance as well. So that's briefly what I can share generally and broadly around challenges, but I'm happy to engage further in more detail as we continue sharing experiences. Thank you.
Thanks so much, Patricia, for such an excellent presentation, and also dealing with some of the issues, giving some examples, highlighting the challenges, and also the good fortune of being able to get the funding for activities. Thank you indeed. So let me now next call upon Lucy.
Thank you, Professor Victor, and thank you very much to the school SOS for giving us this opportunity to make some comments. I want to send thank you to Professor Léonce for that excellent presentation. I think it's been a very good piece of work, and hopefully we can find ways to add value to your work. So I think there's a lot that has been said in terms of many of the analysis of the banks and how they've evolved over time. I think, Professor Léonce, I do agree with most of the sentiments that you've made in terms of how the development banks have got this delicate balance to play in terms of the work that they have to do and also maintaining a stable framework. And I look forward to the discussion on the way forward on the institutional frameworks. So in terms of some of the issues that we've seen in terms of some of the challenges, I think the first thing I want to start off with maybe is to say that because from a development bank, the idea is to take more risk. So there's always that tension between taking more risk and also maintaining financial sustainability. I think if you look at some of the banks, you have to really maintain a sense of financial sustainability. And sometimes the projects that you have to do, you have to be very careful in order to manage the level of risk that you're undertaking. We have seen some of the projects, they are very, very good from a development perspective, but unless maybe you have a pool of capital that is dedicated towards risk taking, then it's going to be very difficult to do that within the governance framework. I mean, as a way forward, what we have done, for example, we do have some solutions in terms of allocating a little bit of capital. It's never enough, I think, to manage all the risks, but there's a little bit of capital that can be put aside. And then that helps us also with issues such as the default rates and so on. But it is always a challenge in order to maintain that delicate balance between the risk-taking ability of the institution and the need to do development work on a sustainable basis. Then the second issue I wanted to highlight is about the issue of the capital. I think you mentioned very succinctly that there's a need for that long-term capital. Now, here the question is, there is capital available. I think even we are fortunate enough to have enough support to raise capital. The question is the cost of that capital, because we do have support, but then we have to, in many cases, raise the capital from the markets. So the cost of that capital has to be managed carefully, because your ability to raise capital at a rate that is affordable, then again influences your ability to on-lend to other parties so that it can make sense from a development point of view. So this balance, once again, between raising affordable capital and making sure that you're able to on-lend to the projects or the programs in a manner that is sustainable is something that we are also needing to deal with. Because in our case, we deal with infrastructure. It's long-term funding, and as you correctly pointed out, I mean, short-term lending is not really, especially from our point of view, is not really where we play. We play in the long-term space. So sometimes it becomes difficult to find the long-term capital at affordable rates. And therefore, we need to just always work carefully in terms of that capital raising exercise. So the capital is there, especially in markets such as ours. It is there. The question is, how do you manage the expectations of your investors in order to, again, on-lend and maintain the affordability parameters of the project or the program? So that is the second point. Then the third point I wanted to raise, because there's a need to maintain financial sustainability, I think from an operational point of view, what we do find is, year on year, you have to make sure that you maintain sufficient pipeline of development projects and programs. So that can be sometimes challenging, but it's not that it's impossible, but maintaining that year on year. So it's something that one needs to keep a very close eye on. Most of the infrastructure projects are long-term, and therefore sometimes the gestation period is very long, but there needs to be that continuous imperatives and continuous need to develop those projects. So as a possible solution, what we have done from the DBS's point of view, in order to continuously maintain that pipeline, we have started certain programs. For example, we have a project preparation program whereby we help sponsors and promoters and governments to develop programs so that there's that sustained pipeline. The sustained pipeline is not only for our purposes as DBSA, but it's also for the broader market. So that catalyzation role, I think, is important in the sense that it also helps us to have a pipeline, but it also helps the rest of the market to have a method of having projects which they can then invest in. Because in markets, for example, in our case, usually the issue is not really about the lack of capital, but it's really about the lack of projects. So the project preparation helps with that catalyzation. And so what we have done is to try and catalyze private sector investments. And I think one of the examples that I can use is the Renewable Energy Independent Power Producers Program in South Africa, whereby the DBSA put in some seed capital to prepare the program. And then after that, there was quite a lot of investment. There was from private sector and also from ourselves, so that there's that sustained pool and sustained programs. The program itself has raised quite a number of dollars, over 200 billion rands. So that has been quite a good program in terms of making sure that there's a pipeline. But it's a continuous program. It's a continuous program, and this problem or challenge is continuous. So it's not only for the energy sector. So we look to see how we can continuously assist in developing the pipeline, because without the pipeline, then there would be no method of stimulating the investments, and there'd be no method of having those development outcomes. And then the last point really is about the macroeconomic environment, which in some cases we all cannot control, but it's something that keeps us awake at night. But I guess in that case, we just have to monitor it quite closely. So I want to thank you again for giving us the opportunity to make those remarks, and I'll just stop here and welcome any further conversations, any further work that you'd like to do. I think as DBSA would be pleased to assist and be part of the project. Thank you very much, Professor.
Oh, thank you so much, Lucy, for outlining those very important points. In particular, and where I concur completely 100%, is the question of pipeline. Yes, there's maybe availability of capital even long term, but I think we have challenges across the continent in terms of generating the pipelines that can actually translate themselves into a bankable developmental projects. Thanks very much for that and the many other points you mentioned. So we've been very fortunate to have the inside challenges from Kampeta, Patricia, Lucy. You know, what's keep the practitioner, the CEO, awake at night thinking about the national development banks. Now, let me turn now to Stephany, and in not more than 10 minutes, please, if you could share with us your insights looking at other development banks outside Africa.
Thank you very much. And I'm also really very grateful for, I learned a lot from the presentations that Léonce and the three practitioners explained to us.
There is some echo. Do you have two gadgets connected in your on your desk? There's some seem to be echo.
I switched one off now, so it should be fine.
Yeah, now this is perfect.
Yeah.
Oh, okay. Okay.
Okay,
Thank
thank
you
you.
very
Please
much.
go ahead.
Sorry about that.
Yeah.
So I wanted to say, is it okay, the echo?
Yes. Yes.
Yes, please go ahead. Yes.
So there has been a real revival of interest. We call it a renaissance of development banks, I think, for two main reasons. One is a need for long-term funding for structural transformation. And secondly is the important counter-cyclical role that development banks have played, and not just in the global financial crisis, but now in COVID time. And both of these functions are extremely relevant for sub-Saharan Africa. Now, development banks are important actors. They have over $11 trillion of assets and lend almost $2.5 trillion annually worldwide, which represents about 10% of world investment. And in the case of sub-Saharan Africa, we've done some initial estimates based on a database of the Agence Française de Développement, and we calculate about $43 billion of total assets in the sub-Saharan African region, which would be perhaps a little bit less proportion to their economies than in the rest of the world. There is a growing research on development banks, but unfortunately not enough on sub-Saharan Africa. And I think that's one of the reasons why Léonce's work and other work we're planning in Africa is so important. In the past, there was all this discussion between role of market, role of state. I think what we tried, for example, to do in the book with Jose Antonio Campo to go beyond the slightly old debates and look how the public and the private sector can work best together in development banks. What are the roles, the desirable scale, the best instruments to maximize both development impact and financial sustainability, and governance, issues of governance. So in the book that you have kindly referred to, we looked at a number of horizontal issues like how to promote best innovation, how to fund infrastructure, counter-cyclical role, regulation. And then we looked at 5 Latin American countries, and German KW and Chinese CDB, the largest development bank. It has about $2.5 trillion of assets. I want to briefly refer not to the book, but also to the major research initiative and conference that we had and presented papers summit in November of last year, where I hope increasingly we will have a greater voice for the issues of African development countries and development banks. So what are the lessons from the Latin American development banks? I think the first is that they fulfill different roles as in other countries. Counter-cyclical role, which sort of complements fiscal and monetary counter-cyclical roles. And as I said, again, very important COVID. And in the global financial crisis, also the regional development banks and the World Bank played a very important counter-cyclical role. But this is now limited by the limited scale of the capital and the lack of appetite of the developed countries in particular to increase their capital. So I think it's a very important issue. For example, a speedy recapitalization of the African Development Bank, provide more support, including for the national development banks in Africa. Also, we stress the role of development banks in funding innovation and entrepreneurship. And we look at specific examples, like the example in Chile of Corfo. We started this initiative called Startup Chile, which attracted both foreign national entrepreneurs and provided them with some initial advantages and funding, and which has been seen as a great success. And also the work of, for example, done for innovation in Bendès. We also wanted to emphasize the importance of funding new sectors, and sometimes cross-cutting sectors, what is called mission-oriented, where often you have high levels of uncertainty, where the private sector is unlikely to fund unless it's very profitable. And good examples of these are in the new green economy and in the digital economy. Also, help deepen domestic financial markets. For example, deepening capital market, local currency paper market. And I think there are interesting examples there from the role that the CDB played in China, which was coming out of a very de-riched economy, and where the CDB actually helped create the domestic bond market, as well as become a major issue. Another function, of course, in Latin America, which is very important also in Africa, is supporting financial inclusion. And we saw that it often linked to developing entrepreneurship in countries like Chile, Colombia. A lot of technical assistance was through SMEs, was linked to developing entrepreneurship, accountancy skills, and so on. And also linked to correspondent banks or institutions. Like in Colombia, they have thousands in the different areas. And finally, of course, there is the important role for global public goods. And very interestingly, KfW and the Chinese Development Bank played absolutely key role in developing the initial funding for solar panels, which was not only important for their countries, but which also led to very increasing, to sharply lowering international costs of solar panels. So we had there a sort of very important public good. So when we evaluated these development banks that we studied in depth, we thought that they had been broadly successful at what they did, and that they adapted flexibly through time to changing challenges. That they went into these new activities like entrepreneurship, innovation, financial inclusion, new sectors. And also, we haven't discussed that too much today, develop new instruments. For example, greater use of guarantees, both first and also second tier lending, and increased role of equity and debt funds. But one overall conclusion was the need in Latin America for a greater scale of development banks. And I think this applies very much to sub-Saharan Africa, because like Latin America, major investment needs, further expanded, of course, by all the problems caused by COVID, and insufficient both public and private investment. And therefore, there is an important role for national development banks to help finance this additional investment. But they can only do that if they have sufficient capital and sufficient additional resources, as our practitioner colleagues have been telling us. So what are the preconditions for development banks to be more successful? As you just mentioned, I think good macro environment. For example, we had the case of Bendès, which was quite a very well-run development bank, but in a context of very bad macroeconomic policies, and that made the performance much more difficult. They operate better, the development banks, if the country has a clear development strategy and clear policy mandate. And in terms of governance, we've concluded, particularly looking at KfW, the German Development Bank, that the trick, which is very difficult to achieve, is to have a development bank which is close to the government, so it can fulfill the policy mandate, but that is independent of narrow political interests, and at the same time works closely with the private sector, financial and non-financial, but that does so in a way, again, it's not captured by narrow political and narrow private interests. So I think this is a tricky, but a very achievable position. So I just want to finish, if I may, with giving some of the conclusions which we reached when we aggregated the conclusions of all the research papers for this big research conference. And one of them was that we needed to make sure that capital is at sufficient scale. That development banks try and move to be just project takers, that is to fund projects that are whose funding is demanded from the private sector, but also to project makers. And this was just referred to in terms of developing one kind of project, but perhaps even going beyond that to have ideas what sectors should be promoted and how to promote. For example, the European Investment Bank is now going heavily into hydrogen-based energy and how energy, how to promote working with the private sector, with the governments, create a new policy framework, design projects, enable the whole sector to move forward, support even the research and innovation. There is, of course, the need to blend with the private sector. And then we emphasize the instruments. And one area that we thought was important, that the instruments should be designed.
Stefan, we can't hear you. Yeah.
Yeah, no, I'm just finishing. So sorry about that. So the instruments have to maximize, as I was saying, development impact and not, for example, maximize leverage. Leverage is, of course, important, but what development banks are really about are maximizing development impact. And therefore, they're also under the need of being financially sustainable. So they have to make profits, but they shouldn't be profit maximizers. I think that's a very important difference with private institutions. And therefore, when they design instruments like guarantees, I wouldn't talk about de-risking the private sector. It's about sharing risks, but also sharing profits. For example, through equity instruments, where both the development bank and the private sector can share both risks and profits. And with a view of particularly, and equity is valuable also in post-COVID times because companies are very highly leveraged, have a lot of debt. And so therefore, if they have greater investment in equity, if the development bank can provide that, then the leverage levels will not increase so much. So there's a lot more, but I don't want to take more time. And I thank you really very much for the opportunity of participating in this really exciting conference. Thank you very much.
Thanks, Stephany, for adding that, many important dimensions and borrowing from the work that you've done over the years, especially in Latin America. Very, very valuable input. Now, I know we have very little time, but we need to bring in contributions from participants. So please look into the channel. You see how you can put up your hand raise the hand and click on, and then I can invite you to make your contributions, comments, or questions. Let me see. Let me see whose hand. Okay, so I can see Abby and Alexis. So Abby, good to see you. Abby, please go ahead and make your comment. And after that, Bob, and then Alex, and then Andrew. Yeah.
Okay, thank you very much. Can you hear me?
Yes, I can hear you very well.
Okay,
Abby.
very good. Thank you, Léonce. And 3 quick, very short points. The first is to say that this is a very good project. As your capital flight project is part of my course for my development finance students, I will also take this as a supplement reading for my development finance students. The second point I want to say is that I am from Ethiopia, so I want to talk briefly about the Development Bank of Ethiopia, which was more than a century old. It was 111 years ago that it was established. I would like to say something in relation to the comments made by Kampeta, Patricia, and Lucy, because the context is very, very important, and institutional parameters that needs to be considered in your analysis, which you correctly identify. Maybe I think the way forward, what I suggest is country-specific focus, because of the public nature of these institutions, particularly in Ethiopia, because we have a developmental state. I see that there is poor credit assessment, credit monitoring, and compromised integrity in credit approvals, which will really affect the effectiveness of these banks, because it's not only about the lending volume and the rate, but also the effectiveness. The last point I want to make is about the regression, maybe in terms of identification. In addition to financial development and endowments in natural resources, I think beyond the bank characteristics, other institutional variables might be important. But I think I stop there.
Thank you very much, Abby. Good points taken. I don't know whether you want to respond, Léonce, or you are muted, Léonce.
Quickly, thanks, Abby. Good to. I didn't even see you. I don't know where your video is. Anyway, I'm going to pretend I see you. And thanks for as I said, I think the least we can do as professors, teachers, is to encourage students to get interested in these topics and push them to do their master's thesis, their honors thesis, and their PhDs on these topics. So thank you very, very much for bringing this in the classroom. Yes, in fact, in my in the case studies that I would like to pursue, the Development Bank of Ethiopia is one of them. And as you correctly stated, it's very important to take into account the country context. First of all, as Stephany said, one of the things that is critically important is having a clear national development strategy. Okay, because the objective is for the development bank to feed into that strategy and be a tool for the strategy. Now, in the case of Ethiopia, we have very clear development strategies, but the governance issues you are pointing out are something I want to really explore in terms of what kind of autonomy is the development bank is given in terms of its operation, evaluating risk and allocating resources. That's very, very important to know that they actually have a model that they were able to apply, and not too much constraint, too much interference from the political side. In terms of model specification, yes, what I meant by the fully specified model is a model that includes a whole range of external indicators and also a whole range of more bank characteristics, and you could see that the results quite changed significantly when we do that. But of course, when I have the full draft, I'll be sure to share with you for more comments. Thank you.
Thanks, Léonce. I think in the interest of time, I'd like to take the comments one after one, and then I'll give you a chance later on.
Yeah, I think that would be
okay. Okay. Yeah. Alexis, another development bank.
Thank you very much.
Sure. Yeah.
Hello, hi, Victor. Hi, Léonce. Thank you so much, Professor Léonce. It's always refreshing to listen to you. My question actually might be maybe looking to in your next round of investigation. This is an issue that development banks have been facing, and this is political lending or political exposure. So we've been looking at the loan books of those institutions, and you see that they were dominated by politically connected people, and they also dominated the NPLs, the non-performing loans. So maybe there is some work to do there. I don't know whether in your investigations you found this. Certainly a regulatory innovation that is needed to shield these institutions so that they can do what they were set up to do. Thank you.
Thank you, Alex. A very important point there. Yeah, Bob.
Thank you. Quick observation, Bob from SOAS, but many years at Citibank and the Senior Treasury Risk Officer of Citi after Treasurer for Africa and other things. One was, I just want to remind a lot of infrastructure long-term lending in the US or in Europe was done by government. And it was done with municipal bonds in the US, government issued. KfW was a post-war creation that was basically about rebuilding Germany. Later, developing work elsewhere. But these are full government agencies. The other is many banks lack long-term sources of funding, liquidity. Their balance sheets, especially in many countries, Africa and elsewhere too, are short-term consumer-based deposits, cash management, flow-throughs. So they don't really have long-term funding. The other is, if everybody uses Basel as a representation, well, on a risk-adjusted basis, long-term infrastructure projects in countries with volatile histories in some of these areas would require enormous amounts of capital for a bank. So it's very costly, no matter what they want to take as a spread, just on a risk-adjusted basis. And that's where, lastly, I just say, it's something Stephany brought up. Risk participation with development banks is important. But things we've done is risk participation where the commercial banks took the shorter term funding risk, credit risk, and the development bank took the longer tail. Because nobody will go out 20 years as a commercial bank, but they might do it on a declining basis. So they could take 80% of the credit risk declining over the first 5 years or 7 or 10. So when you do a risk participation, it doesn't have to be linear. You know, development bank could take the most uncertain longer term simply because banks can't really price that, you know, in a way that's meaningful for the projects. So risk participation, risk sharing can be more dynamic. And remember the punitive side of prudential banking, some of the regulations of Basel brought down to a country level make some of these assets very expensive.
Thank you, Bob. Very, very, great insight and, sharing issues on risk participation and also, of course, the inability of the regulation to do this. Okay, shall we, in the interest of time, move to the next, Joshua?
All right, thank you very much, Victor, and good afternoon to you. And so, quick one. We know that development banks, just like any DFI, occupy the intermediary space between public finance and private investment. So, and I like the point Stephany made about not maximizing profit. So here in Ghana, the government and National Development Bank, and the model they adopt is to route the financing through the traditional bank. So lending institutions would borrow or access funds from this development bank and then on lend. I worked some years ago with one of the ministers, and we were managing an Italian fund. We were routing the facility through the traditional banks, and we were using their typical lending infrastructure to lend. And I don't think we really achieve the objectives of the fund because it was purely commercial. What would be your advice on this model that the Ghanaian government wants to adopt? And they explain that it's a model they're adopting from Germany. What's your take on this?
Okay, Léonce, we come to that if you have taken note of it, the Ghanaian model mentioned by Josh. Okay, let me go back to see whether Andrew is available. Dr. Andrew Mwaba? No? Okay, Oladapo.
Yeah, good afternoon, everybody. Yeah, a quick one. So basically what we have seen in Nigeria is that we've seen duplication of development banks in the economy. So for example, we have the Development Bank of Nigeria, we have the Bank of Agric, we have Bank of Industry, we have even the central bank involving in developmental projects. I think some months ago, the central bank governor was saying he's going to set up an infrastructure fund. So when we now look at the competition in terms of all these organizations, how does it really fit into impact maximization when it comes to development financing?
Thank you.
That's my question.
Okay, very good observation. Thank you. We have Vaibhava Mishra.
Hi, thank you so much for giving me this opportunity to ask this question. My question is very simple. In the developing countries of sub-Saharan Africa, public financing and accumulation of capital for development financing may be a challenge. So, what do you think? Exploring private partnerships or private investment and giving private access to private capital, or a foreign public or foreign private capital, is this a feasible solution for successful sustainable PDB? And how much percentage is the maximum cap for giving ownership to?
Thank you, Vaibhav. And then finally, Adam Shibia. Adam Shibia. Yeah.
Thank you, Professor Murinde, and greetings from Kipra. Mine is just a comment. Indeed, it is a very interesting discussion. What I find one of the issues that I find interesting. One of the issues that I find quite interesting is the fact that the national development banks in a relatively well-developed financial sector are more profitable. Perhaps I think it would be very interesting to understand why. Perhaps there could be issues in terms of well-developed mechanisms for information sharing and the likes. Perhaps there could be issues of less political interference, and also in what context do national development banks have lower non-performing loans? I think those are just some of the interesting things to look forward to going forward. Thank you.
Okay, thank you very much, Adam from Kipra. Let me see any other comments. Yes, Christine.
Thank you, Victor, and thank you, Léonce, and the discussants. Hi there. Christine from SOAS. I just want to, I liked your paper very much, Léonce, and I think it's great to have looked at rates of return, but I just wonder whether the conventional rate of return is the right rate to be looking at for development banks, because the social return could well be much higher. So I'm thinking, at the moment, I think 93 billion has been invested in public finance in vaccine development. The return to that is obviously going to be very high. AstraZeneca is charging £5 a shot for its vaccine because it's decided to do it not for profit. And the other companies are charging £30 to £70 a shot. So, we can look at the private returns and they will tell one story, but the social returns will tell another story. And I mean, I just saw as well the Inter-America Development Bank's investing $1 billion in trying to roll out the vaccine. But measuring the return to that may not be captured fully by the return on assets. So I just wondered, thought the scope was in future for work looking at different measures of returns.
Thank you. And finally, Andrew, I think Andrew seems to be back. Andrew, you're unmuted now. Can you please speak?
Yeah, no, thank you. Thank you, Victor. Thank you so much. I lost my buttons. I couldn't see where to press the to unmute.
There he is. Andrew,
yeah, but
why have you abandoned me?
Andrew.
I want to say, first of all, greetings to Léonce. How are you? Yeah. No, no, thank you so much for this paper. Actually, we found it very, very useful in terms of outlining what the important role the development banks can play. Especially here in Africa. We have got not a very, very developed capital markets. One of the things I've seen is that most of the banks, the problem they face is that of capital or resources. So the issue of resource mobilization is very important. As you know, for most of them, the major shareholder, which is the government, also face similar problems. So injecting new funds becomes an issue. To me, this seems to say that there is room for the private sector investors maybe to invest in the banks. But most efforts to do that have not been very successful. How do you see the private sector coming into development banks as investors? Is there a place for that, and how can that be encouraged? Because some of the banks have been trying to woo investors into them, but they find it very difficult, to take that risk. So how can this be de-risked? My second point is to the heads of the banks who spoke earlier. What have been their experiences in terms of loan repayments? Do they see this as a long-term solution to reduce government interventions? When the reflows increase, you get less and less government intervention. Do they see these loan repayments as a long-term solution, or is government intervention going to be the permanent input into the banks? Thanks.
Thank you, Andrew. And also I can see in the chat room a question from comments Juliet Onyeka, which Léonce will turn to. But Léonce, you have 1 minute in the standard ERC challenges to, if you could give your closing remark.
Did you say I have 1 minute per question?
No, just 1 minute in total. Sorry very much.
Okay, so in that case, I'll just want to first of all express my gratitude for everybody for coming in and sharing your views. I want certainly to follow up with Patricia. Again, grateful for your help with access to data. I want to see if I can get the more updated data. I want also to follow up with Lucy about the BSA. I could see how to get some information from there. And Stephany, of course, I would like to chat a little bit about you mentioned the conference of November. I didn't participate, so but I'd like to. One of the, generally, my view is that there are really, really good things happening in Africa in terms of development banks, but there are also challenges. And I think in terms of thinking about how we address those challenges, let's try to actually learn from home already. What are the good things that are happening in some countries that are making the development banks successful? Again, a question I couldn't resist the issue of how do we measure returns? Certainly for the national development banks, financial returns are important for financial stability. They need to be sustainable. But the key goal is to promote social returns. Things like employment, employment creation, and supporting new emerging sectors like energy, sustainable energy, and youth entrepreneurship, and so on. So thank you, everybody. Since I was given only 1 minute, sorry I couldn't address your questions, but you certainly have, those who don't have my email, I could either Victor, Meng, or myself reach out. I would like to get to hear from you as we work on this project. And some of you may meet me. I may meet you when we resume travel, when I'll be cruising the continent for the research.
Absolutely,
And Andrew, don't forget about me again.
No, I won't. You know. I hope that we can meet in the not too distant future, either here or there.
Yeah, thanks.
So this is our colleagues meeting again. So let me thank all of you, and in particular, thank you, Léonce, for this great work. I think the conversation starts from here. You know, to you, Kampeta, Patricia, Lucy, Stephany, and all the participants, this has been a very, very productive seminar. And I think we are looking into the reimagining of national development banks in Africa. Thank you indeed, and we keep the conversation going. They can see this developing into a mega research project, you know, for the continent, you know, going forward. You know, thank you, and bye-bye.
Thank you. Thank you very much, everybody. Thank you.
Thank you. Bye-bye.
Thank you.